After the subprime crisis, an enormous number of investors fled to the safety of government bonds. A lot of money was invested in treasuries with no regard for the rate of return on these bonds. Today, with the recent turmoil in the Eurozone, treasury bonds are no longer the safe haven investors used to believe in. So where is the European bond market heading? To answer this question, let's welcome Koen Van De Maele, Global Head of Fixed Income Management at Dexia Asset Management. Hello, Koen, and welcome.
Thank you.
Government bonds are usually thought to be one of the safest investments, but the past 2 years were quite complicated with the recent turmoil in the Eurozone. So, Koen, where is the bond market heading in 2011?
Well, on the one hand, we believe that investors will continue to focus on the level of public debt, which is quite high in the developed world, and then investors will reassess the risk-return characteristics of government bonds, and they may consider that they are poorly paid for the risk that they are taking. So we can expect that some institutional investors will go out of government bonds and go into other asset classes, which will put an upwards pressure on government bond yields going forward. On the other hand, you have the monetary authorities that still have a quite accommodative monetary policy. They will keep short-term rates quite low, and they, especially in the United States, they will continue to buy US Treasuries, which will support the government bond market. So all in all, we think that government bond yields could drift a little bit higher in 2011, also driven by decent global economic growth.
Right, so the debt load of some European countries, we can see that they are very high, and we all know that Eurozone countries are tightly interconnected. So investors are becoming more reluctant to hold on to government bonds. I'm talking about European government bonds, and they are demanding higher yields. So is there any hope of return of confidence on the bond market?
Yes, but we believe that the situation will deteriorate before it will improve afterwards, because you have the looming rating downgrades coming into the new year. You have a lot of new supply coming to the market, and it will put the pressure on the government bond markets of the peripheral countries. So the ECB intervened in the market, which was a good thing, but the intervention is only a temporary measure. We believe that permanent and structural solutions are needed to correct the imbalances within the Eurozone, and that's something that the market will be waiting for. And in order to do so, I guess I'm afraid we need to have a more severe crisis to find these solutions.
So what are the opportunities in this low interest rate environment?
Well, there are clearly opportunities, not in the developed world, but in the emerging markets. Emerging markets are benefiting from the crisis to the sense that they already had lower levels of public debt. They have lower deficits, a high economic growth, so they will benefit from the global growth environment, and so it's really worthwhile.
So is it sustainable? I mean, emerging countries, we talked a lot about them during the last years, but what about 2011? Are they still going to be strong?
Yeah, it's perfectly true. So despite the huge performance that we have already seen in the last couple of years, we still are convinced that there is still value left in emerging market bonds.
And what about inflation?
In the developed world, according to us, is not really a near-term risk.
Okay.
Nevertheless, we could anticipate, especially in the United States, that investors will anticipate future inflation, mainly due to the quantitative easing that the Fed is doing right now. So we advise to look at US inflation-linked bonds already today, and maybe later on the year to look also at European inflation-linked bonds.
We know that this market was on the brink of collapse during the last years. So can we say that the credit market is back on track today?
Yes, I think we can say so, but with that, also the corporate fundamentals are much more healthier today than they used to be a couple of years ago. So the companies did kind of deleveraging, they have higher buffer of liquidity, they have aggressively cut costs, so the corporate profile is much better today than it is today, so it's logic that spreads are today lower than they used to be 2 years ago. Another interesting thing that we saw in the market in 2010 is a really decoupling of the corporate bond markets between companies issuing from countries in the core European zone, which performed very well, and to the other hand you have the companies in the peripheral countries, and they suffered a bit, and we really saw a decoupling of these markets over the last year. Going forward, we believe that within financial bonds, regulation will once again be the key determinant in terms of the future performance of financial bonds, because regulation, as you know, is very important, will be there, will stay there, and within the regulation you have positive elements and negative elements. Within the positive elements you have the new Basel III regulation that will help prices of some subordinated financial bonds, because there is an incentive, an increased incentive, that these bonds need to be redeemed earlier than previously anticipated. But on the other hand, you have also the resolution and the bail-in legislation that is coming to the market right now, which is clearly stating that bondholders will participate in any future losses within the financial sector, even before that the government will intervene. So that's clearly quite negative, and that's why we advise to invest only in strong financial groups in stable countries. On the non-financial side, I think there is only value left in the lower quality corporate bonds.
And the dollar is still very competitive, so what should we expect this year?
You should know that within the four major currency zones, you have Japan, US, the UK and the Eurozone, all of them would be greatly helped if their currency would go lower, because then they can export more and then their growth, economic growth, will increase also. So it's difficult to say which of the four zones will be able and will be most successful to drive down its currency. We guess that it may be the United States, because they have powerful tools, quantitative easing and so on. So in the end, we guess that the United States will be most effective to drive down the value of the currency. But nevertheless, what we would advise to our clients is to take a short exposure on these four major currency zones and to go long into a basket of emerging currencies. Mexican peso, Turkish lira, or even Scandinavian bonds, which are not emerging countries, but these, Norway and Sweden, they benefit from lower public debt levels and also a little bit higher interest rates.
Well, Koen, thank you very much for coming today.
Thank you.
Well, we will continue to keep a very close eye on the European government bond market this year, and we will, of course, come back very soon with more news. Thank you for your attention, and goodbye.